In the early stages of a company, whether you're a technology-based ICT company or maybe plans for some sort of manufacturing facility in which you have large assets and buildings, equipment, those things, typically that early stage is called seed financing. And in the seed financing stage, you will be referencing and leaning on friends, families, very key suppliers who may be willing to give you smaller amounts of money to help you reach various milestones, which may be as simple as writing a business plan, securing a lease on a piece of equipment, opening up doors, making 2 trips to a marketing show to understand, is this worth it? So that's in your early stages. You'll go on the seed. Then you may, even in this early stage, you might move then to a thing called development type financing. And in the developmental type financing, you would be leaning on, again, probably some of those same folks and institutions that were involved in your seed financing. And then other groups that typically come to play are government organizations, have various economic development programs. You would lean on suppliers, key suppliers would start to show up, and maybe other partnerships that are out there. That will be very similar to both. As you move to the later stages of development, and between those two, there's a big gap, there's a big hurdle to get over, and often a long period of time. As you move to the later stages of, let's say, a company that's up and running and maybe we're in growth mode as opposed to startup mode, you would then look to the banks. Traditional bank financing may come to play. Equity funds, known as private equity, and typically that could be venture capital type financing or private equity funds, depending on the type of your company. When entering a financing deal, so from I'll break that into 2 components. Let's first talk about an equity investment in which we have an owner coming in with a long-term position. In an equity position, you need to really think about the way into the company. So you're out soliciting investors to join your partnership, become part of your company, be involved with you for a period of time. So there's a lot of definition and time spent explaining how we will set up that relationship. It's equally important to think about the way out, because there may be events that cause goals and objectives to no longer be aligned. So it's important to have a mechanism in place. So the risks on an equity transaction are that the owner is locked in, has given up flexibility, does not have the ability to maybe accept other investors, maybe change its business plan. But however, that's measured against the opportunity created by the new funds that have been received from the investor. So again, it's constantly a balancing act. What one perceives as risk, others sees as opportunity. And so at some point through that whole process, you'll come to a balanced view on that will get, again, alignment of objectives and goals is the key. When it comes to debt financing, in which someone is lending you money, and again, as I said a little bit earlier in one of the interviews, a debt lender is really just interested in two things. One, the ability to repay the money that I loaned you, and as well as whatever interest rate that I may be charging you. That's just typically how a debt instrument is set up, principal plus interest. In that aspect, they are looking for hard security, so physical security. So if you have companies, if you have assets, building, equipment, they may ask for that as security. Debt lenders in the world of security have what's called typically take first right. That means that if in the event that things go poorly and for some reason the company is wound up, the debt lenders really look at it from that perspective. If things went absolutely as poorly as possible, could I be covered? If I'm not, then what extra security do I need? And that may be in the form of the assets, or it may ask the entrepreneur to personally guarantee a certain amount of that loan they've given to them. During the receipt of debt and equity financing, the entrepreneur's interest is protected in, I'll call it the details of the various contract. So there are terms and conditions that are varied within each of those agreements. There are things such as covenants. A covenant is something that the company or maybe the individual makes, and if the covenant is broken, the important thing about a covenant is that if for some reason it's broken, then it automatically will give some fairly strong rights and privileges to the lender or investor. So we often, working with entrepreneurs, will spend a lot of time to pay attention to the covenants. There may be only one or two, and work with the entrepreneur, the lender, or investor to set a series of covenants that, again, balances the interests of the lender or investor with the ability of the company to go ahead and perform what its objectives are, and knowing that their business is not a static event and changes will occur. So try and set those in some method that we don't inadvertently cause an undue event within it. The entrepreneur's interests are also protected during this process, but I'll roll it back at the beginning because hopefully you've been able to secure investment or financing from an organization who's aligned with your goals and objectives, and that's typically the most important way to protect yourself.